At its peak, Adelphia Communications was the sixth largest cable company in the United States, but under the Regis family's control, billions in debt were hidden and the public was misled. This documentary explains how it happened, who did it, what the financial evidence showed, and what we can learn.
Adelphia grew from a regional telecommunications operator in Coudersport, Pennsylvania, into a national multi-system operator in the 90s by acquiring cable systems across the U.S. The company provided cable, internet, home security, and telephone services and got their revenue through subscription fees and advertising revenue. Adelphia remained almost entirely controlled through the Regis family, who retained effective control through super voting shares and multiple executive posts. Scale and capital were critical to staying ahead in the industry. At the turn of the century, cable TV was at its peak with more than 65 million American households having a cable subscription, and companies were looking for new ways to acquire customers due to the buyers' low switching power. Competition was fierce among the already established telecommunication companies due to the wealth of channels and emerging threat of substitutes through new digital products, which gave consumers more options despite the lack of new companies due to the high entrance costs into the market. In addition, there was a pivotal shift moving from a primarily television based business model to a provider of multi-service packages. In response to the new technology and expectations, companies worked on acquiring new systems and networks to support these new products, all of which required heavy financing. That environment created pressure to maintain growth and leverage.
Adelphia relied on scale to lower unit costs and bundled services to keep customers, but those advantages required continuous capital infusions. Adelphia pursued differentiation by investing large amounts into infrastructure and through geographic clustering in local regions. They put an emphasis on certain local regions that were overlooked by some of the bigger companies. The Regis family, John and his sons, dominated Adelphia's board and leadership. Their control, combined with family entities intertwined with the company, created the opportunity for self-dealings. Pressure. Aggressive growth expectations and large acquisition debt created a need to hide leverage. Executives faced market pressures to show steady results and service heavy financing. Opportunity. Family control meant weak internal oversight and easy to access controls. Rationalization. The family treated Adelphia as theirs. They treated loans and guarantees as temporary and justified the use of corporate funds for personal projects.
This is how they did it. Between mid-1999 and the last quarter of 2001, Adelphia co-borrowed with family entities, moved the debt from their books to the family entity books, and fraudulently excluded the debt from the company's annual and quarterly consolidated financial statements. As a result of this misconduct, Adelphia had a total of approximately $2.3 billion in undisclosed off-balance sheet bank debt as of December 31st, 2001. Around the same period, Adelphia regularly boosted their reported performance metrics used by Wall Street to evaluate cable companies, the two largest being the number of its basic cable subscribers and their EBITDA, or earnings before interest, taxes, depreciation, and amortization. And since at least 1998, Adelphia concealed rampant self-dealing by the Regis family, including the family using Adelphia funds to pay for vacation properties, New York City apartments, develop a golf course, and purchase over $772 million of Adelphia shares of common stock and over $563 million of Adelphia notes for the Regis's own benefit. So here we have Adelphia's balance sheet for year in December 31st, 2000, showing the fraudulent balances reported at the time and the restated balances after the fraud was uncovered. These numbers are reported in thousands, so as you can see, Adelphia had $1.63 billion of debt not correctly reported on their balance sheet. But that wasn't all. Adelphia did not stop there. The fraud continued into 2001. Here we have a comparison between the fraudulently reported liability total and the restated liability total for quarter 3 of 2001. Adelphia excluded $1.8 billion of liabilities off of their books in this quarter of 2001 as well. These are just a few examples of the total $2.3 billion exclusion that Adelphia committed. Finally, we see a comparison of the cash totals reported by Adelphia for year ended December 31st, 2000 compared to other competitors in the cable industry. Adelphia was reporting almost double the amount of cash that their competitors were and had little debt to show for it. Investors probably thought that Adelphia was loaded, but in reality, they were drowning in debt.
Now that we've seen the overall $2.3 billion gap in Adelphia's reported versus actual debt, let's break it down quarter by quarter. This chart shows us how much debt was shifted on and off of Adelphia's books between 1999 and 2001. We noticed the extreme volatility. In some quarters, over $700 million was manipulated, while in others, debt was actually reduced by over $200 million. These swings weren't tied to real business activity. They were deliberate misstatements designed to conceal the Rigas family's co-borrowing. The inconsistent pattern highlights just how aggressively Adelphia moved numbers around to disguise its true financial position from investors and regulators. And we just saw how Adelphia shifted hundreds of millions of dollars off the books each quarter to hide the true size of its debt. That concealment was especially important when it came to the company's debt covenants. Adelphia's lenders required the firm to keep its leverage ratios between 6.75 and 9. On paper, Adelphia appeared to be in compliance and comparable to peers. But once the hidden debt is added back, the ratio increases to nearly 14, which is well above the covenant limit and more than double the levels of Comcast, AT&T, and Time Warner. This manipulation allowed Adelphia to keep borrowing and avoid default, even though it was carrying far more leverage than the industry could reasonably support.
The SEC likely relied on a mix of unusual restatements and late filings, analyst and whistleblower tips, suspicious financing disclosures, such as co-borrowing language in bank documents, and follow-the-money tracing that linked debt reclassifications to family-owned entities. Deloitte failed to detect the scheme due to the lack of professional skepticism and sufficient related party procedures. Co-borrowing and related party reviews should have been more rigorous. The fallout was severe. John Rigas was sentenced to 15 years in prison, Timothy Rigas 20 years in prison, and Michael Rigas 10 months of house arrest. The family paid $1.5 billion in fines, and the company filed Chapter 11 bankruptcy before selling its assets to Comcast and Time Warner in 2006. The lessons learned include strengthening board independence, mandating disclosure of related party agreements, rotating auditors, enhancing related party testing, and using data analytics such as cash flow versus earnings comparisons and related party volatility comparisons to detect misstatements.
Adelphia rose as a family empire,
but their unchecked power enabled concealment.
Billions in debt were hidden from the public.
Forensic analysis shows the numbers didn't add up.
Data analytics should have highlighted the anomalies.
Stronger governance and audit procedures are the solution. Thanks for watching.